Private equity continues to make headlines. We saw Blackstone listing in the US within the past week. Joining us in the studio is Ivan Missankov from Momentum. He's just spent some time out of the country improving his knowledge on private equity back in South Africa. What can you tell us?
Good evening, Brian. What I can tell you is private equity is very much in the news internationally, in the financial press. In the UK, in the US, it is all over the newspaper headlines. Private equity are rightly being called the kings of Wall Street at the moment, private equity players. So a very, very topical item in financial circles. I think Blackstone made the news, big headlines, firstly with the Chinese government announcing that the Chinese government fund would buy into their new IPO, and subsequently with a very, very successful IPO.
Should pension funds and other institutions be investing in private equity?
It is my opinion that it is imperative that pension funds and other institutional investors, not only in South Africa but worldwide, should be considering private equity for their portfolios for two reasons. At Momentum, we have conducted reasonably in-depth studies and research into the historical returns of private equity in South Africa. We found a performance premium of 18% per annum historically, going back 15 years over listed markets. So what that is to say is, on a gross basis, private equity would have performed 18% better every year on average than listed markets would have. Of course, there is an associated long-term investment horizon, which makes it exceptionally suitable for institutions such as pension funds to invest in.
What do you put that outperformance to?
There's a number of reasons. I think private equity players operate away from the glare of the spotlights from the listed markets. They pay a lot of attention to putting in specialist management. They target companies that can be improved upon or perhaps inefficiently run. From a management perspective, they improve the financial structure of the company, etc., etc. And of course, last but not least, the prices that they're buying at, if they buy at low prices, and if they're able to sell at good prices on the listed markets.
Ivan, we're going to pick up on the discussion just after the break. Stay with us. We'll be back right after this break.
Welcome back. We're with Ivan Missankov. He is the private equity specialist at Momentum, and he told us before the break that private equity has outperformed listed equities by 18% over a 13-year time frame.
Elaborate on what pension funds and institutions should be looking for when they invest in private equity.
Sure, Bronwyn. I think investment in private equity can be contemplated from the conventional set of factors that any pension fund trustee or investment consultant, for that matter, or any other investor should consider. What is the liability profile of the pension fund in particular? Is it a long-term liability profile? Does it require real benefits over the long term? So looking at the asset class, you would look at the expected return of private equity going forward. We've already commented on that, 18% per annum on average above listed markets, which is very compelling. But also the diversification benefits. Does it behave in a similar manner to other asset classes in the pension fund portfolio, such as listed equities, international equities, or bonds? Momentum, again, in its in-depth studies, has found that there's very little correlation with listed markets. So that is an additional benefit. It really does improve the risk-return profile of a pension scheme.
In comparison to private equity, what's weighing on listed stocks that is allowing for private equity to beat them in performance?
I wouldn't necessarily describe 290% return over 4 years in listed markets as being weighed on by anything in particular.
I think 18% over the 13 years,
yes, of course.
Which is minimal compared.
I would say that private equity performed even better than listed markets. And again, for the reasons we discussed, because they're away from media attention and from listed market scrutiny and so on, they can often come in at reasonably good entry prices, and that, with the amount of money that's flowing internationally into private equity, that is becoming increasingly difficult. They do tend to exit at the right time of the cycle in the market when there's a listed bull market, or they can sell to other buyers. They place a lot of emphasis on good management and good financial structures in their target companies.
But the other obvious ones are they don't have listing costs, and also the nimbleness. They don't have to go to a board and perhaps go through a long process when they do decide to exit an asset.
That's absolutely right.
Let's look at some important trends in private equity in the South African space.
Locally, I think what you're seeing really is a continuation of what's happening internationally, and you alluded to that with my return recently from a 2-week trip to New York and London, where it's been very, very interesting talking to established private equity players in these developed markets. As I said, private equity is very much in the news. There's a lot of capital being raised. You're seeing that in South Africa. I think the prices at which private equity players going forward will be moving into the market are likely to be less competitive, if I can call it that. The prices will be high internationally. It is very difficult to buy at a discount, if at all. Although I have to say, private equity players do say that the very largest companies have never been exposed to private equity discipline. They see opportunities in that. The smaller companies which are not listed, they also still see opportunities in those. So that's very interesting. I think we're going to see that locally as well. We're going to see, and we are seeing, foreign players coming in a big way. As well. And of course the widespread use of leverage, I think one of the big drivers internationally has been the low cost of borrowing, which has further fueled the private equity boom internationally. So it's very, very interesting. And of course you're seeing the listing. I think I was approached by a journalist, South African journalist, to ask whether there would be a similar event in South Africa, which I couldn't comment on. But again, it was further evidence of international trends being replicated in South Africa.
One of the major newspapers reported this morning that there's a cool-off in private equity. Did you get that sense from your trips abroad?
It would depend on what a how a cool-off is defined. Perhaps you could elaborate if it was the pricing that less funds were being raised, or there were fewer new entrants, or
Well, it's essentially talking about the deals that are being done.
At Momentum, again, we try and keep abreast of exactly what's happening. One of our major concerns, we see private equity as a compelling asset class, which should be in institutional portfolios. We are concerned about the success. It almost, as usual with investments, anything that's successful ultimately starts working against itself over time because it attracts more money, more attention. The opportunity to generate returns decreases. We have been concerned internationally and to some extent in South Africa as well, as to the extent of the prices that deals are being discussed and negotiated. So we maintain a concern going forward whether returns will be as compelling regarding the pricing. There's no clear evidence of that happening. And also what's important is private equity is a very long-term investment. In other words, investments are not committed today. You raise a fund of 5 billion, you invest it today, and that's it at the price of today. It is committed over a period of 4 to 5 years, and that works in favor of private